Nic, tell me something that you believe about real estate right now that might surprise us.
So this is contrarian, but I believe right now is one of the best times in the last 100 years to be investing in real estate in the majority of markets in the majority of segments.
Listeners, welcome to The Source of Commercial Real Estate, where we talk to the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. My name is Jonathan Hayek. I'm your host, and I'm a former public school teacher who found financial freedom through residential real estate investing. And now I invest in commercial properties, particularly small industrial. Today, I'm talking with Nic DeAngelo. He is the founder of Saint Investment Group, and he has a really impressive portfolio. He owns properties in more than 20 states. They have 24 projects going on, has closed over 500 loans, and they're just doing a ton of really interesting stuff. So I am sincerely looking forward to this conversation. Nic, thank you for joining me. How are you doing today?
Jonathan, I'm doing great. Really excited to be here. Even just catching up a little beforehand and your knowledge of the market and your experience. Really excited to dive in with you and talk about some fun stuff.
I loved hearing about your contrarian viewpoint, sort of contrarian. There are some people out there that share that viewpoint, but really looking forward to getting into your thoughts on the current real estate market. But first, before we get there, why don't you tell us a little bit about your background and what your work in real estate looks like today?
Sure. So the two biggest highlights of my background are I always grew up around an entrepreneurial family. So the entrepreneurial mindset and stepping into a market knowing that there's endless opportunity and that it can be entered at any level is something that I hold very close. My earliest entry into real estate was with a couple small family offices where I got to work really closely with the founders and kind of the patriarchs of those families, worked with multi-generations, learned from just giants and had the ability to absorb a lot quickly. It was in the middle of the Great Recession, so I leaned into acquisitions at that period of time. I made my name early on in distressed acquisitions. So anytime there's market uncertainty or anytime there's potential downtrends or anytime there's people sitting on the sidelines because, it's choppy waters and they're not sure what to do or how to navigate, this feels like home to me. So I think it's a huge opportunity. That's where my background is from. So it feels comfortable. But we transitioned at Saint. We bought a whole bunch of properties for these great groups. Woke up one day with too many properties that they were in over their head on the asset management. So we founded Saint Investment Group in 2015. Since then, we have averaged an average IRR of 35.5% to investors. So we're very proud of that in 5 or 6 different asset classes. And today we focus on fixed income because we have seen where the market's going. We have our long-term view of what the most stable and what the highest likelihood of success assets are within the real estate space. And like I said, I'm just really optimistic about the future if investors choose the right assets in the right locations.
And so I'm clear. What do you mean by a focus on fixed income?
So what we woke up with, we have the amazing benefit, but also difficulty with dealing with a huge number of really sophisticated investors. We're dealing with individuals that have very large portfolios, very seasoned in real estate. So the expectation of deal performance and asymmetric returns of risk versus reward is very much higher than what we're normally used to in like the retail investor space. So what we found and the trend that we saw was many of these very intense, very sophisticated, well-seasoned investors were shifting away from risky investments, away from maybe a standard syndication model or a 5 to 7 year hold, and wanted something that's a little bit more liquid and that pays a fixed return. So we looked at what our best performance and best experience was in the past. We decided that that residential mortgage notes throughout the U.S. were the absolute best risk-adjusted return that we could find. So we pooled, you mentioned it earlier, we pooled over 500 loans together to put together the Saint Income Fund, which is what we focus on today. We pay returns, 12 to 14% on the upper end for our top performing product. So we decided for our investors, which is what they wanted, a fixed income, something that they could rely on, that they could balance their portfolio against, that mortgages were absolutely unquestionably the best asset to support that need.
All right. Really interesting. That went in a direction that I was not expecting. So I am looking forward to, we'll definitely get into that. But when I was researching for this conversation, I heard you on another podcast and you were talking about your early work with a family office. And I think that is such an interesting way to get involved in real estate because it's really being thrown into the fire. A lot of people get involved in real estate by buying a house hack or buying a duplex and sort of learning on the smaller deals and working your way up. But it sounds like from your work with a family office, you really got thrown into some really decent sized deals. And so I'd love to hear a little bit more about how your work, learning your sort of intro to real estate, coming up with a family office, impacted your outlook on real estate and how you view real estate today.
So that's a great question because it's very close to my heart. I've actually never gotten that question. The family office mentality is very different. And I want to be clear and upfront. This is a small family office, multi-generational, right? Very successful, an amazing group, an amazing family, an amazing backbone of what they're doing, but much smaller. When you think of family office, you might think 6 billion under management. This was not the group that I was with, but I got to see what multi-generational investing looked like. And I got to see that in the middle of the Great Recession, which at that time was the worst economic storm that we had ever had, right? So all of these really interesting things coalescing into one moment in time where I got to really, really see some interesting stuff. Here are the biggest takeaways that I got from that experience. One is to think in terms of decades and not in terms of little tiny increments of time. Think bigger, think longer. So the economic cycle, it's not a, hey, can I hit one deal and get this quick pop or this quick return? It's, do we want to hold this for a decade? Would we be proud of this asset and believe it would perform consistently over the next decade? That's a huge one, is just in terms of time. The second is just to think on a portfolio perspective, which is, that's a hard skill for early real estate investors, especially if they're kind of going deal by deal, is things balance each other out necessarily over a period of time. So if you're investing in one asset class in one market, and then you're investing in a different asset class in a different market, oftentimes if you time that, or if you structure that appropriately, those can offset the risk for one another. The third is, many people lean into multifamily for many amazing reasons. There's so many benefits to it, and it's a hugely advantaged asset class in real estate. What was interesting was multifamily was not anywhere near where I started. I started in essentially everything but multifamily. So by the time multifamily had really started hitting its stride and people were really interested in it, I was like, wait, there's a lot of other asset classes out here doing a lot of amazing things. So the menu and the asset management skill set and teams that we had in place, I had been exposed to so many different ways of asset managing real estate and so many different ways to do that. So by the time, I was blessed that they gave me a shot on acquisitions, right? I was way too young for it. Some weeks I'd be holding $10 million in cashier's checks in my jacket pocket on the courthouse steps. Nobody would make that bet on an early 20-something-year-old kid in the middle of the Great Recession, okay? But people gave me a really big shot, and I can't thank them enough for that. So by the time I, added a little different spin to acquisitions, by the time I stepped in with a little different spin on acquisitions, and they already had the back-end system and the asset management in place, it really was teed up for huge things. So I credit the environment. I credit, many of the mentors and people that were around me, but I did kind of have a chip on my shoulder. I did push hard for that job. I did work for free, and I did have to barter my way in to work for free. I couldn't even get a job for free. Okay. Because that's how bad the market was. So, that's many years condensed into kind of a, I don't know, medium answer, but it was such a blessing, and it is a different path. I don't know a lot of people that usually start on the family office side, but I was blessed to have that opportunity.
I'm so intrigued by this juxtaposition of people that get into real estate by doing big deals. And it sounds like, from what you're describing, you almost got into it at an institutional level versus someone like me and maybe a lot of listeners who, I got into real estate bootstrapping it. And so it was, almost like a scarcity mindset from the start. I was a teacher. I was flipping houses and buying duplexes on nights and weekends and school holidays, and scraping by with credit card balance transfers to try to close deals, and checking couch cushions to try to bring money to closing. And that was my foray into real estate, and it was great for me, and it got me to where I was. But then I talked to someone like you and several other guests that I've had on that have scaled to the hundreds of millions of dollars and hundreds of transactions. And it's simply a different mindset when you get into it on a larger scale and you're going to the courthouse steps with checks for $10 million. It's totally different than having to, check couch cushions and get a new credit card so you can pay the rehab expenses on this new single family flip. And so I just want to, identify for listeners that, there are lots of different ways to get into real estate, and it totally impacts your way of thinking. I mean, have you seen that? Certainly you've talked with other real estate investors who are doing single families and duplexes and are like, how do I do bigger deals? I mean, can you identify that, the way you got into real estate has really impacted the way you're doing deals today?
Absolutely. It's so apparent. Many of my best friends are on the multifamily side. So we compare notes all the time because that's a different world than what we play in, and what I do is a different world than what they play in. And so comparing notes benefits both of our operations and strategy so much. One of the benefits that I got used to very early was just a lot of zeros. Right. And when you're looking at deals and it's numbers on a spreadsheet and, it's 50 tenants, or huge numbers of tenants instead of just small numbers of tenants, it's variables instead of like these very personal anxiety, data point. It's really, really, really non-emotional. And I learned that early on, and I'd hear numbers and be like, is this deal too big? And they're like, too big? This thing has a 40% a likely 40% return. We need to go keep doing these as much as we can, right? So it was not, they were like, what do you mean too big? We'll find the money. It's not about the money. It's about, does the deal make sense? And it was this huge switch of, instead of being petrified, which I was by big numbers very early on, instead of being so afraid of the numbers and the scale and the size, it really calms you and centers you just to say, hey, it's just more zeros. You have to run a tight deal either way. You have to go in with your strategies in place. You have to know how to pivot and maneuver when you need to. You have to have a leasing strategy, an exit strategy, a value add strategy. It's just real estate, And so that was a big thing, is being able to shake off the scale of things. And I share that with friends all the time. It's like, oftentimes with early friends in the business, what's the best advice you can give? And I'm like, you're finding success, right? Oh yeah, we're doing really good. Well, why would you not do 10x of that, or add a zero to your number of doors on this deal, or and usually if someone's pressed to perform on that, like how would you do that if you had to? A lot of these people, especially in real estate, it's such a smart and entrepreneurial mindset community. I think most people can figure out bigger deals if they commit to it. I think they'll find it's less scary. It's not even close to as scary as what they thought. And the payoff so much more. You're already putting in the effort. You're already putting in the due diligence. So thinking bigger on that, I think you almost owe it to yourself. I'll go that far.
Yeah, I mean, that really hits home for me. I am certainly guilty of when the numbers get bigger. I get I get that little pit in my stomach, and my fear goes up a little bit because, it's just, for the most part, my deals are just me signing on the line. And when the numbers get bigger and the deals get bigger, I think, man, this one deal might sink me, if things don't go well. So I really take your advice to heart, and, trying to, be smart about deals, but take the emotion out of it. So yeah, thank you for that. I want to get into the work of Saint Investment Group. So, looking at your website, you have an impressive portfolio. You've done deals all over the country. You have a portfolio of lots of non-residential properties, and I know you all are now focused on this fixed income strategy. So, I want to start with your current portfolio, and you have, if listeners are listening to this, check out your website. Really nice mix of industrial properties, retail, some office, mostly in California. So, will you tell me a little bit about kind of the history of Sane Investment Group, and what your current portfolio looks like before this fixed income strategy comes in?
Sure. So we're most optimistic about fixed income and most optimistic about a diversified, nationwide strategy on the mortgage market. That said, before the current market conditions, which we're in today, we focused pretty much across commercial for a decade plus. So you're exactly right. We've done deals, office, retail, specialty, limited zoning stuff, complex mixed use, and then industrial was a little bit later to the party for us. But after doing and performing well in so many different asset classes, we started slimming down what we like to do and really niching into what we were best and most successful at, which was industrial. I still it's my favorite asset class by a mile as far as a standard property, right? As far as like a classic, syndication style purchase or syndication strategy, for me, industrial is no question my personal favorite. And there's a lot of reasons for that. One of which being we have a really good acquisition strategy and we're really dialed in. Another being that as you look at even, domestic politics and geopolitics, so, things happening in the US economy and things happening in the global economy, there's such a massive drive into industrial that if you're a good operator and you can buy deals well, there's so much upside over the next 10, 20 years is what we see. So industrial is really our focus. When we do syndication models, when we do a deal and we buy a single, 123 Main Street single address deal, and we raise that with investors, it will very likely be industrial for our next raise there, for kind of all those reasons.
Yeah, you're preaching to the choir. I love industrial
I
assets. I particularly love single tenant industrial. How about you? What's kind of your bread and butter? What do you like? Do you like single tenant? Are you looking at multi-tenant, small bay, class A? What kind of stuff do you like?
So I'll ultra drill down because I love industrial, and many of those that you just mentioned are so killer in so many markets. For us, distribution warehouse, pretty middle of the fairway, right? So it's wide open, concrete tilt up style, construction style. We're looking probably our average is probably, let's say, 50 to 100,000 square feet. So we try to sneak in right under that institutional level, right above the everyday mom and pop affordability. And we really focus on, like you said, Southern California market. There's a sliver that is very, very interesting because it's so impacted by the ports of Long Beach and the ports of LA, and so many offshore imports coming in through there, as well as Mexican production, Mexican manufacturing. So we really like that southwestern pocket in California. And then the other market we focus on, same property types, same property sizes typically, is the Texas Triangle. So that neck of the woods in Texas, again, southern US, offers a lot of shipping benefits, a lot of port benefits through the coast there, and a lot of Mexican manufacturing coming up and nearshoring. So those are our bread and butter industrial.
The strategy makes a ton of sense. When I research industrial, I hear about Orange County and the Inland Empire, and just what a monstrosity those two areas have become for industrial. And of course, Texas, there's been a lot of onshoring and nearshoring to Mexico. And so that area, trucks coming up through Texas to the rest of the continental U.S. is poised to be a really attractive market for industrial. But Nic, it seems like you are still doing industrial deals, but you're also are pivoting a little bit, and you're bringing in this other fixed income strategy. So I'd love to know, get your thoughts on sort of the economy as a whole and the real estate market from your perspective. What are you seeing right now that tells you that this is a good time to shift from those single asset deals to more of this mortgage note and fixed income strategy?
Sure. So I'll give you both. I'll give you the tactics, the zoom in, and I'll give you the strategy, the zoom out a little bit. As far as tactically in the weeds of asset classes on that side, so we typically do the single tenant building, single tenant, triple net industrial. So when you're dealing with the space and the users that we are, being too early in a cycle is the same as being wrong. It's very obvious, because if you lock in a lease, which is 100% of your occupancy on that building, and you're too early on that, you got to deal with that for 5 years, right? So that drags your expected return down dramatically. So right now in our key markets with how we purchase, that's not the perfect timing we're looking for. We're waiting a little bit to see how a few market drivers shake out, and we will evaluate at that time, probably later 2024, maybe early 25. We'll see where those markets are at. Go ahead.
Can you clarify what you mean by being too early? Do you expect rent rates to rise and you're worried about locking in rents that are too low, or what exactly do you mean by being too early?
That's exactly right. I think there's so many question marks around the broader economy. Because industrial, a lot of those drivers are importers, exporters. Just take the news that's come out in the last handful of days, the Chinese tariffs, right? Some of these discussions are 100% tariffs, right? I'm positive you've seen this in industrial. So with that being the case, if you're an industrial distributor, you have a big warehouse, you buy huge amounts of goods and you distribute them from another country throughout the US, and you're dealing with unknown tariffs that are on the table right now for up to 100%, how likely are you to expand your business, right? So and this is one of, a dozen different question marks. Others include, are you getting your goods from China, or are you getting them from Mexico, or are you getting them from Malaysia? Where are you even sourcing things at, as Chinese labor and labor costs go way sky high? They're 15x since the year 2000, right? So the world manufacturing and the world, where the world warehouses and the world manufactures its goods is shifting quite a bit. And as that unfolds, and as we learn more about the real core inflation of the US and what we see, even though we got good news recently, it was a little bit good news, right? It was a little on the right side after a handful of months of some scary numbers popping up. I think that many manufacturers, many distributors are still waiting to see. And I think what that equals to, as investors like you and I in industrial, is some unknowns on the leasing. And anytime a tenant has an unknown, that's a risk premium, right? They say, hey, I got to take an extra discount, or I can't move into that other space, or I'm better off negotiating with my current landlord. So in our markets, we're seeing some slight softening on the leasing markets, where it's not always the pricing going down, but the time on market is so much more. The lease negotiations have shifted quite a bit, to where I still am super bullish on industrial, and we've been doing industrial for a long time now. But that market, I think, has some questions that need to be answered over the next year.
Okay, that makes a ton of sense. So to me, it just sounds like there's a little too much uncertainty for you. And in the markets in which you're interested in, you're looking to wait to see how things shake out over the next couple of years. And it ties back into, one of your lessons from the family office was have a long-term mindset, a decade's perspective. And it sounds like long-term, you're very bullish on the industrial asset class, but potentially in the next year or two, maybe a little too much uncertainty that you don't want to get locked into a bad deal.
Sure.
I completely understand that. So let's talk about your transition to note investing and this
Sure.
fixed income strategy. So what is the opportunity right now that you see with this particular strategy?
So the US is, by any definition of financial markets, we are a one in a million, right? You look at the perfect storm of natural resources, economy, brain power, good demographics, good location. So we get to sit in this one in a million chance that all these things coalesce into this amazing market. And as many issues as we have, the rest of the world typically has it much worse, right? Whatever it is, inflation, debt to GDP ratios, growth, demographic questions. The US is in such a good place in so many areas. The weirdest and most interesting thing that I'm seeing right now, that I'm tracking very detailed and our team is tracking, is right under our noses, that's barely being talked about, is the biggest wealth transfer in history. Nobody is covering this in the amount of detail it deserves. So with the baby boomer generation, which are aging out of the workforce and are moving towards their retirement years, the biggest wealth transfer in history from the biggest generation that was also the most wealthy is occurring right now. So between now and 2043, so for the next 20 years or so, we can expect $73 trillion to be passing along from the baby boomer generation that is passing on, sadly, over the next couple decades to younger generations and recircling throughout the US. And to give interesting perspective on that, the US, that's, almost 3x what the US GDP is annually, right? So staggering numbers coming up over the next couple decades of how much money is recirculating back into the system and where that's going. The interesting thing, if you check and if we look at the last 15 years, is the ridiculously low cost of capital and the much, much easier access to capital that we've all enjoyed in real estate and really in every other market in the business field. So all that to be said is things have changed. We're now dealing with record inflation we haven't seen in 40 plus years. We're now dealing with much more difficult access to capital. A lot of that is driven by this money coming off of the playing field, being out of circulation and being pulled back to more conservative investments. So at Saint, we took the lead of our sophisticated investors, and they're saying, Nick, I don't want to wait 5 years to see if a deal is going to pan out. They always have. We've never lost our investors' money. We've never not returned investor capital, and we've never not paid a preferred return even, right? So we have a great track record, but that's not where our investors' heads are at. Many are much older. Many are very successful. They wanted something they could rely on with a fixed rate of return from a stable asset class that's real estate backed. At the same time that people are stepping and taking their money off the sidelines to more standard return fixed income investments, we also see a different trend that also no one's talking about, which is the shrinking actually of the stock market. Okay. So 1996 was the peak of the number of companies in the stock market. There were 7,300 publicly traded companies in 1996. Today, there's 40% less companies by number. So where do those companies go, right? Where are those companies? Well, private equity is now purchasing 6x what it was in 1996. So this huge shift from public to private ownership of key companies and key industries that are huge return drivers for investors. We're seeing things go more private. So between those two trends, we saw things reach a point and reach an opportunity where we could give investors through real estate, through quote unquote alternative assets, a return that would beat the average stock market return through super stabilized US mortgages with fixed rates over 30, up to 30 years. That's kind of where we saw the markets going and saw the most interesting entry point for a long-term evergreen fund. So that's kind of the background and the big data points we've been watching for the last handful of years that led us to put together the income fund.
It makes a ton of sense. And I raise a small amount of money from friends and family. And I also do what you're calling fixed income deals, where it's just a set return. There isn't, there's a certain, uh, there's a certain subset of investors that in your case, they're extremely sophisticated. There are other investors that are maybe not as sophisticated, and they don't understand preferred returns and waterfalls and GPLP splits. And at the end of the day, they just want to know, how much money am I making
Yep.
on this deal? And so I really liked the fixed income idea because it's not confusing. And I honestly think it's a really good deal for passive investors, because in a lot of cases, you're in a preferred spot on the capital stack. You're not at the mercy of who the property manager is, and how this deal could go. And so I really like that. I am not super familiar with exactly how note investing goes. So, could you give me and our listeners maybe a crash course in note investing 101? Because my confusion is, it's my understanding that a lot of Americans have locked in 30-year mortgages at super low interest rates, and they have a ton of equity in their properties, and they're likely not going anywhere for a long time because they have such great loans. So piece this together for me. Why is there opportunity in potential 12 to 14% returns on 30-year fixed interest mortgage notes?
So that's the key question. And that's, as someone, I can tell you invest in real estate and you're sophisticated to know the space, because how do you create a delta if the average mortgage that are typically being traded today might be in the fours and the fives max, right? And they're 20, 30 years left on many of these mortgages. How does a 12% return exist? So on our side, to be 100% upfront, my background is in distressed assets. So after trading tens of millions with many financial institutions, banks, we have relationships. We've done deals together. We trust each other. The mortgage space and the secondary mortgage market, as it's called, is extremely tight knit, because if, let's say, Wells Fargo, for instance, sells a pool of mortgages to a less reputable company, and they foreclose on a bunch of people that shouldn't be foreclosed on, or they have funny business or bad ways of doing business, that often goes back on Wells Fargo, right? So there's a reputational risk in mortgages that's so extremely high since 2008 that banks are extremely, extremely, extremely playing those assets close to the vest. So what we do, having a background in distressed assets, is we buy mortgages with very minor problems. So we pay a steep discount, oftentimes 30% plus, for the unpaid balance, right? So if, let's say, a mortgage is owed 100,000 left on the unpaid balance, maybe we'll pay in the 60s, right? In 60,000, or 60, in the 60s for the price of that mortgage. On our side, oftentimes, especially today in this environment, many of them are individuals that maybe missed a handful of payments during COVID. Hey, they got furloughed, right? It's a family. They pay their bills. They have no interest in taking advantage of a financial institution or ripping anybody off. They kind of just need somebody to call them and work through the details and give them a second chance on that. So we're in a unique position where many people in the distressed or the non-performing mortgage non-performing note space do a lot of foreclosures. We have almost none. We have very few. That's very far from our business, because we're trying to do long-term loan modifications with these borrowers. We're typically looking for families that are occupying the house. This isn't some secondary investment. This is where they live and they want to stay there. We're looking for middle class neighborhoods, middle class valuations on the homes. We're looking for good amounts of loan to value. So we average, I think it was, the last look was about 39% equity on average. So we're looking very conservatively. And we want these individuals, even if they have a good rate, we buy a steep enough discount off of the unpaid balance of that loan that it creates a good return for us, for our investors, and a borrower gets to stay in the home knowing that they have 20 years left of a low rate that they will never, ever get if they don't pay their mortgage on time, right? So it really creates kind of a win-win-win, and it allows us to plan decades ahead with investing strategies, which kind of was the goal with the whole process.
I connect with your idea of looking for distress, and we never wish distress on anyone, and we're not hoping that homeowners or businesses or properties go into distress. But the types of investors that we are, distress happens, and we're not hoping for it, but we are the types of investors that are willing to take on a little more work in order to get a little more a little more return, and there might be a little more risk in that. So it sounds to me like your business plan is to buy mortgage notes at a discount, and maybe at some point in the last few years there have been missed payments. Maybe they are currently behind, maybe they're not, but you're buying it at such a discount, say 30 or 40% discount, that even if they do pay off their entire loan long term, they might pay off their 100K balance. You only paid 60K for it. And so then there's a 40K profit plus interest there. And you're not wishing distress. You're not looking to foreclose. It sounds like you're looking to work something out with these borrowers. You're not trying to foreclose on them. Do I have that business plan right?
Absolutely. That's like a very cookie cutter example. Obviously, there's a million variables in every single deal that's different. We've seen across the board, but that is a very, very middle of the road, good explanation of it. And it allows enough for everybody to have a win. And even the banks get a win because they get to clear their books up. By the way, you look at big banking institutions, their business model is to originate loans. They get the fees, they get to move that money. And when those loans don't pay, they can't throw the non-performing or the semi-performing loans in a pool with 10,000 others and sell them to another institution. They have to set those off to the side, and it's a huge drag on their portfolio. So it's even a win for the banks to give a discount at that point.
And I imagine a lot of lenders aren't thrilled about having tons of 3 and 4% loans on their books. And so when they get a loan that is now behind, and so now they're not even getting that 3 or 4%, maybe there's a little extra motivation from the lender to unload that. And so they can get the capital back and redeploy that capital now at 7 or 8%.
Yeah. And you just look at the comptroller of currencies or other regulation bodies that these banks have to deal with. They have a lot of pressure to not have bad loans on their books, especially mid-sized banks today. But anyways, yeah.
So tell me about how the fund works. So you mentioned 12 to 14%. Tell me about the size of the fund. How do returns work? And then my big question is, if this is a long-term strategy, potentially decades, and you're not looking to foreclose quickly and flip these houses, how do the returns work out if this is a decades-long strategy?
Sure. So we actually budget so that we know a very, very, very clear likelihood of what we can expect at Saint, because we got to pay our bills. We got to keep the lights on. We know we've never missed a distribution, or we've never underpaid investors on any of the investor distributions. It's a stabilized model when you're looking at a multi-decade payoff period for these mortgages, so we can plan out ahead. And we also are very conservative in all the other things you should be in an evergreen fund. But we pay out a 12% return on a cash flow basis. So investors are making 1% a month. We need what is that? That's a 36-month lockup on our 12% return, because we need time to make sure that these loans are seasoned, that we can, work through them. We can sell any loans that don't fit our portfolio's expectations. So we can only keep the cream of the crop from there. And then on our side, we budget in our return above that, which is several percent. It's enough that we always have a margin. It's also enough that our lights are always on, and that we have a buffer that if anything were to go wrong, that we're stabilized for the future. So that's kind of the the ultra streamlined version. As far as it looks, decades out, that's really the plan. Things will shift over time. I think in about 15 years, we'll start to see the real impact of the baby boomers moving out of the residential market. Probably a lot of that being, passing on, and those homes then being either passed, sold before they, passed on to heirs and then sold, and seeing, it's part of that 72 trillion dollars that are being redistributed through the system, and seeing where that goes. But I think we're pretty stabilized, because around that same time, the 15, 20-year period, we see the millennials, which is the next largest generation, right? Millennials are the kids of the baby boomers. Big generation had another big generation. We're seeing the millennials really lean into home ownership and home purchasing. Also Gen X, and but millennials being such a big demographic that it looks like even after that 20-year period and homes turning over, the decade transition from one large generation to the other, should be pretty stable at that period of time from what we're seeing today as well.
Really interesting business model. And listeners, this is not an advertisement or an encouragement to invest in this fund, but I really like talking about this stuff because I have just a little bit of a contrarian personality. And so when I hear about something different, something that's not a multifamily single asset syndication of a 6-pref and a 70-30 split, my ears perk up a little bit, and I'm very much attracted personally to the fixed income idea. Both, I think it's good for passive investors. I think it's good for the operator too. And so really appreciate that deep dive. I'd like to ask you about passive investor sentiment. And so you talked about having more sophisticated investors and having some big numbers and some big investors. So will you talk about what about this? I mean, we already did a little bit, but talk about passive investor sentiment generally, and why they seem to be attracted to this type of fund.
Sure. It's such a weird and positive and negative time, like everything at one time for passive investors right now. There's so much uncertainty. We're in a freaking election year, which didn't used to be what it is today, which is huge question marks of where the economy will go and what we'll be doing. And so we've seen a lot of even really smart, even really sophisticated, seasoned investors that are just kind of holding their breath. And that's been interesting. But also interestingly is the other half of investors that we're seeing that are looking at what's going on in the economy and going, I want to make moves to something stable, but I still want the freaking returns, right? I can't sit on my hands. And that's a newer trend where I feel like the last couple years, there's already been that holding breath mentality that's been growing over time. I mean, look at the last 10 years, Jonathan, how much money has been sitting on the sidelines. Oh, I'm waiting for the right market opportunity. I'm waiting for the right opportunity. And now I think people have seen enough to where they're like, well, things are stable enough that if I sit in cash, I'm going to be getting crushed by inflation. So investors are caught between the rock and the hard place of inflation on one side and risk on the other. So I think they're looking for stability. On our side, again, we work with a little bit of an older crowd. Typically, we're working with, either our two biggest demographics that we work with are boomers that are transitioning out of maybe a business or transitioning into retirement. They have a good chunk of change and they want something that they can rely on that's very stable, very conservative. The other is business owners, entrepreneurs, because what we found that in times like this, where there's so much instability in other places, that business owners are looking for a fixed income that offsets maybe their lumpy cycles in their business. So that's close to my heart. I've sold a couple businesses over the years. So if we can help that community, that's something that I'm really proud of. I think people are at the point where, with the highs and the lows, with the news cycle kind of being constantly up and down, that opportunities like you're talking about on your side with fixed income, opportunities that are more closely tied to long-term thinking, are things that people are leaning into. And we're seeing that very heavily.
Nic, this has been a great conversation. I want to be mindful of your time, but I've got a few more questions that I'd love to ask you. These are designed to be a little more quick hitting questions, but if you've got a great example or a story, feel free to take as much time as you want. So, why don't we start out with, are there any habits or daily practices that have a big contribution to your success?
Absolutely. I look at my life in three categories. I oversimplify everything because that way I can just be really good at a very small list of things. Health, wealth, and legacy are the three things I focus on every minute of every day, 100%. And I really kind of do my days in that order. I always start with health. I get to the gym 5-6 days a week. Right now, I'm geeking out on powerlifting. I really enjoy just trying to pick up the heaviest thing that I can pick up. So that's been a huge joy of mine lately on the health side. Wealth, I deeply focus on what I'm doing in the office, making sure I'm adding value to our investors. I really just love the economy. I love investing as a passion on my own. And it brings opportunities to make the world a better place, right? There's some people have the gift of philanthropy and the gift of nonprofit work and the gift of these amazing skill sets. I lean towards the entrepreneurial side and the investment side. And I know that through my efforts, I can impact those things and leave a legacy in positive ways. And then I try to end the day with my kids. Honestly, I got 3 kids. They recenter me on the thing. So every single day, I'm trying to start with health, then move on to wealth, and then end the day with legacy to kind of keep a mindset of those 3 things.
Nic, if you could 10x a certain part of your business, what would it be and why?
That is such an interesting question. Net income would always be towards the top, right? That's the easy one. But a skill set that I think is misunderstood. The value of it is incredible hiring practices. If you have a superpower in your business of hiring top talent and can get to the best people and the widest net of absolute top tier level 10 talent, I really truly think you can do anything on this planet. So if I could 10x anything, I would say we're pretty competitive in the hiring space. It's been a huge focus of ours, and it's led to a ridiculously, our Saint team is really stacked, and I'm really blessed that I get to even have these conversations with these people and work on such big projects with them all the time. But hiring for us, I will always want to 10x hiring processes and getting to the best people.
What's the best deal you've done?
Oh, that's a good question. So memory lane, real quick. You want story time on a good deal? I would say the best deal we've ever done was a zoning change, and it was a very low value kind of tertiary, secondary market where it was becoming a hotspot for a shipping lane. So it was an industrial deal, and it was just, frankly, the city did not understand zoning at a high level. So this is a lot of geeky, like layers of real estate geekery right here. Okay. But I'll go into it. In order to get this done, we had to connect with city councils. We had to show them zoning maps. We had to show them benefits of going with different legislation to benefit different shipping industries, et cetera, et cetera, et cetera. But what that translated into and where we're at on that deal today is we were able to purchase something and essentially 5x, 4x the value immediately of the base asset of that building, and cash flow. I think our cash flow on that's like north of 50% per year, right? 50% return on cash. So ridiculous looking at zoning changes. We've done that in a number of cities, but that one's a huge standout. And then, we have deals that we purchased at trustee sale, so foreclosure sale, all commercial. We didn't really ever want to do the residential side there. It's a little too personal, and it's a little too not what we like to deal with. We appreciate a business process, but some of these deals at trustee sale, you're dealing with 7 million cash in your pocket. You're purchasing it at a 48% discount to market. Still, those are some of my earliest deals. Those are some of the the volume's the highest, it's the most intensity, and I still value those experiences so much. Between those two, those are the top two for sure.
Tell me about your worst deal and what'd you do about it?
The worst deal, I learned one of the most important lessons, and it was a deal in a very tertiary market. It was an office product that we purchased. We got such a ridiculous, Jonathan, I think we purchased it with a 40-something% discount to market. Okay. How could that go wrong? Right. Well, I'll tell you exactly how that could go wrong. It was across from a courthouse in a very, very tertiary market. And we purchased it. It was clearly mismanaged. We thought, hey, these guys are idiots. They don't know what they're doing. We could always do better. We've always done great. What we learned was the most important thing. One of the most important things I've ever learned is that the market's always bigger than the entrepreneur, than the manager, right? The market is always bigger. And the market trends in this market were the following. It was across from a courthouse, and it was called Courthouse Plaza. So it was professional services and retail services that were directly linked to the success of that courthouse. With that courthouse leaving, we were completely high and dry, right? That was a huge, huge, huge rocking of that boat for us. So that was one piece. The second was, it was a market that was a net loss of demographics. People were moving out at a faster rate than they were moving in. Population was going down. Not only that, income was going down. Not only, it was all the economic factors were going the wrong way, but we bought at such a ridiculously low price. We thought, how could this go wrong if we just bump it up and get out of it and kind of lease it up and move on. And we did make decent returns. I think it was, we about 18 IRR. So we're proud of that, but I've never worked harder for 18 IRR than that deal in my entire life. It took leasing to government agencies, probably, 10,000 cold calls between me and my leasing team. We've never worked harder. And what we learned at the end of it was, at the end of the day, we'd rather pay a fair price for a great asset than a great price for a fair asset, right? It's the old Warren Buffett quote, and that slapped me in the face. And that was the deal that almost was a massive problem for us. Got kind of lucky on some big leases at the end, but it could have gone the other way.
Nic, tell me a few of your best tips for working with high net worth passive investors or family offices.
I would say be very clear on your assets, be very clear on how you generate your returns, and be very clear on your risk profiles. If they understand that you understand those things and you can communicate those clearly and you can demonstrate those clearly, they will understand where you fit in their portfolio. There's sometimes you're just never going to fit, or they're not a fit for you. There's other times where you are dead center, a perfect fit. And if you can't explain it and you can't illustrate that and you can't show that well enough, it's not that you're not a good fit. It's that they don't understand well enough to place you where they need you. So the second is it's sourcing. It's how do you get to these individuals? How do you get to these family offices, right? These relationships are, one in a million, right? They're extremely rare. They're hard to build. They're hard to get to people. So that your network that you have is never more important than when you're dealing with a very select small group of people, and figuring out different ways to surround yourself with these people. And again, they're great. They're fantastic individuals. Many are just like the people you want to be around. They love their families. They want to give back to their community. They're successful. They work hard. Who wouldn't want to be around these individuals, right? But they're not easy to access. They're not easy to find. There's not a phone book of ultra wealthy, successful people. So I would say between those 2 points, those are going to be high leverage points if investors are looking to connect with them.
Finally, Nic, if listeners want to connect with you, learn more about you, and learn more about Saint Investment Group, where would you like to send people?
We have so we do a ton of economic research. We put out free webinars. We give everything away for free because we're already doing the work. We want, the more educated our investor base is and the people we work with, the more success they have, the more success we have. We give it all away for free at saintinvestment.com/resources. They can find talks that I've personally done at different events. They can find, hour plus long webinars. They can find schedules for, live Q&As that we do just kind of for fun to touch base with our investor community. And it's all for free. So that's a great resource.
Great. Nic, I loved this conversation. You are clearly passionate about commercial real estate. You love talking about it. And I am very grateful and thankful that we were able to connect today. Thank you so much for joining me.
Jonathan, it's been a blast, man. I look forward to connecting with you in the future. And thanks for having me and having some fun today.
Listeners, thank you so much for listening. We appreciate you, and we clearly love talking about commercial real estate. So if you want to connect with us, please reach out to either one of us. Thank you so much for listening. Until next time, take care.